There is a massive liquidity vacuum forming in the cryptocurrency market right now that almost nobody is talking about. While the retail crowd is distracted by daily price fluctuations and social media hype, the institutional order books are flashing red warning signals for the month of February. We are staring down the barrel of a multi-billion-dollar supply shock that has the potential to derail the current market structure. This is not about standard market volatility or the usual ebb and flow of trading volume. We are specifically looking at the upcoming token generation events and massive unlocks for two of the most anticipated projects in the space, which are Hyperliquid and Berachain. If you are currently holding positions in Bitcoin, Ethereum, or any major altcoin, you need to understand the mechanics of what is about to happen. The market is currently pricing in a continuation of the bullish trend, without accounting for the sheer weight of new supply hitting the market. When billions of dollars in new tokens are distributed to airdrop hunters and early venture capital investors, that liquidity has to come from somewhere. It usually comes from your existing positions as capital rotates out of established assets to chase the new, shiny object. The reality is that most investors are completely unprepared for the volatility that hits when the market tries to absorb this much new supply in such a short window. Over the next 8 minutes, I'm going to walk you through the exact data regarding the hype and Bera unlocks. I will show you why February could be the most dangerous month of the quarter for leveraged traders. We will look at the historical precedents for these types of liquidity shocks and how they have previously crashed local market tops. Do not let your portfolio become the exit liquidity for early insiders. Let us get into the weeds. To understand the magnitude of this impending event, we first need to look at the current state of market depth. Market depth refers to the ability of an exchange to sustain relatively large market orders without impacting the price of the security. Right now, the aggregated market depth across the top 10 global exchanges is sitting at a level we have not seen since late 2020. This means the order books are thin, and it takes significantly less selling pressure to drive prices down than it did 6 months ago. Into this fragile environment, we are about to introduce two massive supply events. The first major catalyst is the token generation event and subsequent airdrop distribution for Hyperliquid, commonly referred to as HYPE. Hyperliquid has built an incredible amount of momentum as a decentralized perpetual exchange. The platform has generated billions in volume and has attracted a massive user base speculating on this exact moment. However, the valuation models we are seeing in the private markets suggest a fully diluted valuation that rivals established Layer 1 blockchains. When this token goes live, we are not just talking about a few $1 million entering the ecosystem. We are looking at a potential circulating supply valuation in the billions of dollars appearing overnight. The recipients of these tokens are largely comprised of active traders and farmers who have spent months paying fees to earn this allocation. The psychological profile of this market participant suggests they are highly likely to sell a significant portion of their allocation immediately to recoup costs. This creates an immediate sell wall that market makers must absorb. If the market makers step back, which they often do during periods of high volatility, the price discovery phase can be brutal. This is not just a problem for holders of the HYPE token. It sucks stablecoin liquidity out of the entire ecosystem. Traders will sell Bitcoin and Ethereum to generate the cash needed to bid on HYPE, causing a bleed across the major assets. Here's why this matters for your broader portfolio. When liquidity is drained from the majors to chase a new launch, the support levels for Bitcoin become much weaker. We saw this exact dynamic play out during the launch of other major Layer 2 tokens in the past cycle. Now, Berachain has cultivated one of the most dedicated communities in the entire cryptocurrency space. Their proof of liquidity consensus mechanism is novel, and the hype surrounding the project is palpable. However, the Bera token launch is expected to be one of the largest capital events of the year. We are talking about a project that has raised substantial amounts of capital from top-tier venture firms at very high valuations. When you combine the hype launch with the Bera launch in the same 4-week window of February, you create a perfect storm. You have two massive gravity wells sucking up every available dollar of USDT and USDC in the market. This is what we call a liquidity shock. The total amount of stablecoins sitting on exchanges has been stagnant for the last 30 days. There is no new influx of external capital entering the market fast enough to absorb these two massive assets simultaneously. This is a zero-sum game in the short term. For Berachain to trade at a multi-billion-dollar valuation, billions of dollars worth of other assets must be sold or rotated. We have analyzed the on-chain flows from similar events in the past. The data shows that in the 48 hours leading up to a major token generation event, Bitcoin dominance tends to tick up as altcoins are sold off. We need to discuss the specific dates and the vesting schedules that are often hidden in the fine print. Many retail investors assume that once the token is launched, the selling is over. That is a dangerous misconception. The initial airdrop is just the first wave. For Berachain specifically, you need to watch the schedule for the ecosystem incentives. These are tokens used to bribe liquidity providers to move their assets to the new chain. While this increases the total value locked on Berachain, it is mercenary capital. Mercenary capital has no loyalty. We saw this with the collapse of various algorithmic stablecoin ecosystems in 2022. While Berachain is architecturally different, the behavior of the capital flows remains the same. The 30-day moving average for exchange inflows is currently signaling caution. Whales are positioning themselves in stablecoins, not in risk assets, as they prepare to snipe these launches. This is the smart money play. They wait for the liquidity shock to force retail investors to capitulate, and then they enter the market. You need to ask yourself if you have the patience to wait with them. The reality is that most people will get caught up in the fear of missing out. They will try to buy the exact moment the token lists on the exchange. History tells us that 90% of the time, buying the listing candle is a losing strategy. The winning strategy is to wait for the market to digest the supply shock. Let us look at the broader implications for the Ethereum ecosystem. Both Hyperliquid and Berachain are effectively competitors for Ethereum liquidity. Hyperliquid is building its own Layer 1, specifically optimized for trading. Berachain is an EVM-compatible Layer 1 built on the Cosmos SDK. Both are vampire attacking the Ethereum user base. This means we could see a temporary depression in Ethereum prices as ETH is bridged out and sold for these new native tokens. If you are a long-term Ethereum holder, February might be a painful month to watch the charts. However, this also presents an opportunity. If the fundamentals of Ethereum have not changed, then a price drop driven by a temporary liquidity migration is a buying opportunity. But you can only take advantage of that opportunity if you are liquid. If you are fully invested right now, you are a passenger, not a driver. You have no agency to act on the market dislocations that are coming. This brings us to the concept of exit liquidity, which is a term often thrown around but rarely understood. In this context, exit liquidity refers to the existing order book depth that allows early farmers to cash out. If the order books are as thin as our data suggests, the slippage on these sales will be massive. We could see wicks to the downside that are 20 or 30% deeper than the average volatility. This is where the leverage traders get wiped out. If you are trading with high leverage on Hype or Bera during the first week of launch, you are effectively gambling. The market makers know where the liquidation levels are. They will hunt those levels relentlessly to accumulate inventory before allowing the price to discover its true value. This is a game of survival. The market is designed to transfer wealth from the impatient to the patient. Now, consider the macro environment surrounding this. We are in a period where the Federal Reserve policy is still uncertain. The dollar index is showing strength again. When the dollar is strong and crypto liquidity is thin, new supply shocks are felt 10 times harder. You cannot ignore the macro headwinds while analyzing specific crypto catalysts. They are interconnected. If this level of detailed breakdown is valuable to your strategy, make sure you are notified of our next update by subscribing to the channel. We are approaching the conclusion of this analysis, so let us synthesize this into an actionable plan. The month of February is going to be defined by a battle for liquidity. Hyperliquid and Berachain are the two heavyweights entering the ring. They will suck the air out of the room for almost every other narrative. The old narratives of artificial intelligence coins or gaming tokens will likely bleed against these new entrants. This is the rotation of the cycle. The new shiny object always commands a premium until the supply unlocks, flood the market. Your job is not to chase the premium. Your job is to identify the point of maximum saturation. That is the point where the sellers have exhausted their inventory and the organic demand begins to take over. That usually happens 3 to 4 weeks after the initial launch. So, what is the playbook for the next 30 days? First, do not use leverage on these new assets in the first week. The volatility will be driven by low liquidity and high manipulation. Second, watch the Bitcoin and Ethereum pairs closely. If you see major weakness in the majors while Hype and Bera are soaring, that is a divergence that will eventually correct. The market will eventually return to the mean. Third, keep a significant portion of your portfolio in stable coins. Cash is a position. It gives you the optionality to buy distressed assets when the liquidity shock hits its peak. Do do not feel the need to be fully invested at all times. The best traders spend most of their time waiting. They wait for the fat pitch. The liquidity shock of February is not a reason to panic, but it is a reason to be extremely cautious. The massive token unlocks of Hype and Bera represent a transfer of wealth from the many to the few. Ensure you are on the right side of that transfer. Approach this month with a defensive mindset and let the market come to you. Disclaimer, I am not a financial advisor. The content presented in this video is for informational and educational purposes only. Cryptocurrency markets are highly volatile and carry a significant risk of loss. Always conduct your own due diligence and consult with a professional financial advisor before making any investment decisions. Stay sharp, stay liquid, and watch the order books.